Millions of seniors will see smaller Social Security checks starting in July. The reduced benefit payments are how the Social Security Administration is attempting to recoup money that it overpaid to some Americans. The administration plans to withhold 50% of a beneficiary's monthly check until the sum of their overpayments is reclaimed. But many people have questions about this, and we want to give you answers. So joining me now is Yahoo Finance's Kerry, Hannon, and Bob Powell in a Social Security edition of Ask Yahoo Finance Anything. Thank you both for being here. Kerry, let's start with you, because some of your readers wrote in about this, and one asks, quote, is there a defined way to quickly determine your correct Social Security payment early on to avoid being overpaid? And if you are, is there an easy method to correct the situation? So this person obviously wants to be proactive and make sure they are not overpaid, so then they don't have to give up some of their check on the other side. What do you say?
Yeah, absolutely, Julie. Of course, nothing's ever super easy, but the best thing to do is immediately go to the Social Security Administration's website, and hopefully you have your My Social Security account set up. If you do, you can get a snapshot right there of what your benefits are, what your check is to be, and they can send you a proof of confirmation of what that number is. So if for some reason you get a check that's not matching that, you know that there's something amiss here. But the point is, if it's already occurred and there's something you really need to take control of as quickly as possible, the best thing to do is get in touch, go to the website once again, and they provide a link for you to go ahead and pay it. You know, just get it done. If it's not too much and you can do that, by all means, you can do that by credit card. You can also ask for smaller payments if that 50% is going to be too much, because frankly, a lot of seniors really rely on these checks to meet their cost of living each month. And so you can make a case for having smaller amounts taken out. By law, the government does have to recoup this money. So they're not trying to be evil about this. It's just it's been miscalculated by them, or somebody did not give them the income information change that they might have had. The third thing you can do is say, you know, you absolutely cannot afford this, and you put in a petition to waive the payment altogether. The final thing you can do, Julie, is to ask for a reconsideration, to say, you know, I don't believe that I was actually overpaid, or, you know, frankly, it wasn't my fault if I was. And so that's another step you can take, but be proactive. Don't sit and wait. If possible, see whatever tools you can use to move forward.
And Kerry, we have another question for you. One reader asks, I sold my house last year, they say, and paid capital gains. Will the income from the sale affect my Social Security check? So, Kerry, this person wants to know if they need to tell Social Security about that sale in case they think she was overpaid, given the boost to her income. What's the answer to this one?
I know. Well, great question, right? Because, you know, they consider your earnings as part of how much your Social Security benefit is if you're, before a certain age. And so this is important to know. But the good news is no, they do not consider capital gains as something that is considered in your earned income. So you're off the hook there.
Yeah, I would just mention, Julie, too, that any increase in someone's provisional income, though, can lead to a greater portion of their Social Security benefits being subject to income tax. And for just by way of background, your adjusted gross income or provisional income is your AGI plus muni bond interest and half of your Social Security benefits, if you want to get a sense of what portion of your Social Security will be taxed.
Gotcha. All right. Well, another big Social Security topic is changes to tax policy. That includes an additional $6,000 tax deduction for seniors age 65 and older. So, Bob, give us the overview. What do seniors need to know about this?
Yeah, so first off, this provision does not eliminate Social Security benefits or taxes on Social Security benefits outright. It allows an extra deduction of up to $6,000 per taxpayer who is age 65 and older, regardless of whether they currently receive Social Security benefits or not. The deduction is age-based, not benefit-dependent. It's a deduction and not an exclusion. It's not refundable, which means that if the deduction exceeds your taxable income, you won't receive a refund. It's available to both people who itemize and as well as those who use the standard deduction. It does require a valid Social Security number. It's temporary. It's set to expire in 2028. And it's also subject to modified adjusted gross income phase outs beginning at $150,000 for joint filers. So the deduction does not eliminate taxation of benefits, but according to the White House, it will take the number of beneficiaries who pay no tax on their benefits from around 40 to 50% upwards to 88%,
Oh,
according
wow.
to the, yeah.
Yeah, big change. All right. Well, one more question we got for you, Bob, is how will the senior deduction affect my Roth IRA conversion plan? So what's the answer to that one?
Yeah, this is an interesting one. So right now I mentioned that you get a $6,000 deduction, and that equates to about $12,000. Not about equals $12,000 per couple, and that deduction is reduced to zero at between $150,000 and $250,000 of modified adjusted gross income. So according to Bob Keebler, who's done some analysis, this phase out creates what he would call a tax cliff for Roth conversions at the $150,000 of modified adjusted gross income level. So for instance, a married couple who's age 65, they would qualify for the full $12,000 deduction, and that would equate to, on paper, a tax savings of $2,640. But what happens is if you do say a $100,000 Roth conversion, then it would push your modified adjusted gross income up to $250,000, and that could trigger a 22% income tax, but also wipe out the senior deduction. So at first glance, it looks like this conversion would be beneficial, but when you do the numbers, it's not. So the ultimate advice here, the tax planning tip, is to model all these Roth conversions before you do them, and to determine whether it would be better to do the Roth conversion before you turn 65 or after you turn 65.
Okay. And finally,
Bob,
yeah, go ahead,
I
Kerry.
would note just quickly, Julie, that as Bob was talking about too, since with this new law that went into effect, the taxes are staying relatively low since they're not going to bump back up. And so it makes making a Roth conversion a bit more enticing for people to do this at these lower tax rates.
Okay. And now, Kerry, you also got a question on the new senior deduction. One reader writes, since the deduction will lower my adjusted gross income, will it affect the premium I pay on Medicare?
I got to say, this is a very good question because the Medicare premiums are determined by your adjusted gross income. So if in fact you are able to take advantage of this deduction, the $6,000 deduction, that will lower your adjusted gross income. And in essence, that will maybe impact what you're going to pay in your Medicare premiums. These go on a sliding scale, and it starts about at adjusted gross incomes for a single filer around 106,000, I think is this year, 100 and so forth. So if you think of that as your starting point and it sort of graduates down, it may very well help you out there. The problem is it'll be 2 years from now. It's a 2-year lag between when they look at this, your income. So for right now, for 2025, they're looking at 2023.
Gotcha.
Yeah.
Thank you both so much.
One thing really I would mention too is, folks, according to the Medicare Trustees Report, the Medicare Part B premium is estimated to increase 11% to above $200 for 2020.